Pretty much living on channels for educational purposes only and is not intended as financial advice. Monday, Macro Monday. We got to start with the weekly crypto flows. James over at CoinShares hooking us up per usual. And he says minor outflows of 9 million, divergent between Europe and the US. Not even a period today on this sentence. Just giving you a hard time, James, but not much going on the institutional flow side. And as he notes, most of the outflows are US. Most of the inflows were non-US, net negative. We did have some outflows from short Bitcoin as well. So basically just flat on the week. Germany, where those inflows are coming from. We did have pretty big inflow in the land that time forgot on Bitcoin, where Saylor, who still has, I think, 600 million dry powder to buy more Bitcoin, bought some BTC at an average price of 27K. And if you want to track all his buys, you can go to the Saylor tracker. They haven't updated this yet for that most current purchase, but you can look at all the purchases. You can look at the average price. Should you be interested? Before we talk about yields in the DXY, let me mention today's video sponsor, Kraken Pro. Kraken Pro is a complete overhaul of the Kraken trading experience with a one-stop shop for advanced and professional traders. Kraken Pro enables efficient trading execution across multiple markets with a UI that allows for unique optimization tailored to your trading style. You can check out Kraken Pro with the link in the description of this video. And it's always worth reiterating, not your keys, not your coins. You really have to trust the exchanges you're participating in. I've trusted Kraken for years, continue to trust Kraken. I have no issues with Kraken. But there are other exchanges that are having issues, most of them being offshore. So it's always good to take a look around and make sure you trust who you're trading with, because crypto is still somewhat of a clown show on the exchange side of things. Link up something around 7% today. Still ranging, but it looks to me like people are trying to lift this thing off in a bearish period. I still don't care about it until it's at 850. You know, I'm sheepish, I'm shy. I don't want to be a community member just yet. And another issue with a setup like this is you tend to have buyers at the bottom of the range, and no one, again, wants to buy at the top, right, of the range. So it gets kind of difficult to break out unless there's some big catalyst or big buyer who eventually steps in. Now, as for the DXY, unfortunately for the crypto side of things, dollar strength continues. Death of the dollar is greatly overstated. We are still the world reserve currency. There is still a great demand for US dollars. And on a relative basis, we continue to strengthen. And as we strengthen, anything paired against the dollar should weaken, theoretically. So either this is a bearish rising wedge, and we get some relief or reprieve here, or this is going to be the 11th straight week of bullishness from the DXY, and we're just going to keep going to 107. Now, a bearish mean reversion would be somewhere around 103. Otherwise, thus far, it looks pretty good. You know, trend is undisputably bullish. It's above the 200, it's above the cloud. It's got a chart pattern, it's got an escape from a bearish channel. So it looks very good. And anything paired against that does not look so good. I got a comment on yesterday's video from one NTRC ... He said, "Sir, please focus more on what is different this time than what rhymes." So yesterday I was talking about the euro basically being a crystal ball for you on the Bitcoin side of things, as well as real yields having pressure on everything, right? As real yields rise, the urge to throw money into a risk-off vehicle rises. And then it's a self-fulfilling prophecy in a sense that all the flows tend to go towards those yielding products. Now, even despite that, yields continue to rise. So like I said with yesterday's video, something's got to give. Now, if we look at gold relative to real yield, and you have to have an idea for yourself, are you bullish on real yield? Are you bullish on yields versus CPI or not? If you're bullish on real yield, then that should drag everything down, unless this idea of gold being a safe haven, Bitcoin being a safe haven asset starts to play out. In a vacuum, the technicals for gold, just on a yearly basis, very similar to Bitcoin. Head and shoulders all day at neckline resistance currently. Certainly doesn't look ready for upside. If I had to take a bet right now, this second, I would bet down. The more real yields pull their gravitational forces and bring capital into everything else that isn't that isn't gold, that isn't stocks, that isn't Bitcoin, theoretically, that should pull everything else down, right? Real yields up. This is inverted, by the way. Left axis. Just a pro tip. If you want to invert anything on TradingView, you can use the shortcut Alt-I, or you can right-click the scale and just select invert scale. So I personally think real yields are continuing to be bullish, will continue to be bullish, and that will continue to have a bearish pressure, a headwind on everything, including gold. And we can play around with this, we can zoom in and out. Where did we break this trend? Did we break this real yield trend at the beginning of the year? Was it post BTFP? Was it the US government debt ceiling fiasco where this broke? I think we broke at various points. I certainly don't think the debt ceiling stuff helped, but we definitely started to diverge from following real yields to the downside so far. I personally don't think that we're going to hold up here, even though I do agree that gold can act as a safe haven, Bitcoin can act as a safe haven. Here's a chart from Bloomberg. If you think I'm a crazy person, zoomed way out, multi-year basis. They're saying the relationship started to break basically at the beginning of the year. So if you believe gold's a safe haven, Bitcoin's a safe haven, if you believe that yields are going higher, then sure. I still maintain this belief personally that although yields are probably going higher, the front end of the curve is where it's at. Yes, we are drowning in debt. Undeniably, this is parabolic insanity with no end in sight, right? And eventually we will have to pay the price, as James says. Macro Thinker has a Bitcoin fund. Eventually the sins in the Treasury and the Fed will catch up with us, right? The question is that going to happen sooner or later? Or much, much later? And I think if you're in crypto watching this video, you think it's going to happen sooner rather than later. And I'm right there with you. But in the moment, in the current time period, I think real yields are going to continue to push everything down because they will continue to suck capital inside of them. Here's Bitcoin versus gold, which I would argue that is pretty highly correlated. Not perfect, right? But pretty highly correlated. Also holds, bearish fractals, let's just say, because I know people are sick of me talking about head and shoulders. If we want to measure that to the downside, assuming this does break down, sub 1800, people will say, well, that's not possible. There's all these central banks buying and blah, blah, blah. Sure, but the technicals do not look bullish at the moment. And here's the euro, by the way. The reason I was bringing up the euro yesterday is because I'm saying, look, it's a crystal ball. It's telling you Bitcoin's future. It has led Bitcoin historically 30 days, 60 days, 90 days, up to a year out. But it, for the most part, has led Bitcoin. So either it's going to decouple and Bitcoin's going to go its own way. It's a safe haven, right? We have that mindset. Or it's going to continue to correlate with the euro and should be bearish, right? Because this is not bullish in any regard, just based on TA, regardless of fundamentals. This may bounce, retest the neckline, whatever, but in the moment, certainly does not look bullish. And the euro, by the way, has a history of deep, deep bearish moves. And it's no coincidence that Dixie looks the inverse of this. Dixie looks the inverse of gold. Dixie looks the inverse of Bitcoin, right? Which is one of the reasons so many people talk about DXY all the time. Gold also below the daily cloud. So look, if this stuff starts to make higher highs, if the dollar pulls back, Bitcoin gets to 28, I'm all for it. I'm also all on the safe haven bandwagon. But in the moment, things do not look bullish across the board. And if you want to zoom out, I love Tavi because he's like the laser-eyed Bitcoin maxi for commodities, right? If we want to zoom out, I agree with this chart 100,000%. This is a cup and handle all day. Everybody sees that. These are quarterly candles, so he zoomed way out. I could not agree more. But this could take a very long time to play out, right? A very long time. And as he says, T-bills being a very crowded trade. I'm not going to disagree, but this could take a while to work its way through the system. Another one of the charts that he shared, gold relative to the S&P 500 is basically at 100-year lows, right? All the way back since 1900, average 1.66. So it would just make sense that we'd see some sort of mean reversion here. Now that doesn't mean that gold breaks out of 2K. Gold could just hold steady as the S&P retraces and this thing would snap back to 1.66, right? So you maintain your purchasing power in a way, but it doesn't guarantee a breakout on gold. Switching gears to oil, trend still looks bullish. As we talked about last week, it's reached its logical conclusion based on the Adam and Eve double bottom here. Another sort of TKC clamp forming. The last TKC clamp failed to fully pull back, but there's definitely a yin and the yang here between technicals looking overbought and OPEC continuing to cut and squeeze the world effectively. if we look at the projections for the supply-demand imbalance, there's projected to be 3 million barrels of supply imbalance in Q4. So if you are a bull on oil, that's exactly what you want to see. You want to see OPEC continue to cut. You want to see technicals continue to just basically get ignored and let this thing keep going. It's certainly possible. And that's going to be a problem come inflation time. Not saying not saying that oil will keep going, but they have the powers to make sure it keeps going, right? OPEC can continue to cut if they wanted to, but in a vacuum, I'd expect the oil to settle down in the moment. But if it doesn't settle down, right, it's going to work its way through inflation. This is truflation. Currently basically flat, has held flat. I think it's logical at this point that truflation is going to maintain a level between 2 and 3%, whereas US CPI going to maintain a level potentially between 2.5% and 4% at this point. Let's check the other side of the pond here. UK continuing to come down pretty rapidly and significantly, which is good news for everyone over there. But they've got a long way to go. And if we look at the US nowcast, basically saying the next month's print for this month will be 3.7, which is basically smack dab where it was in the previous month. So that aligns with truflation. So you have the housing numbers making their way through the CPI data, which is a 6-month lag. And then you've got energy rising, which is fighting that decline in CPI. So if you're the Fed, yes, you're going to hold rates right where they are or keep raising so long as unemployment is fine, right? Now we have unemployment numbers next week. We'll see. But in the moment, they're not going anywhere, right? Now they'll sort of sneak their way into the press whether or not they think they're going to hike come November or December. Market's not convinced that they'll hike just yet. Maybe yields on bonds will do that for them, right? And if we look at it, months between the last hike and the eventual recession, could be a year away, right? We could still be in this limbo state where yield curves are inverted and everyone's ready for a soft landing for the next year, and then the recession hits, right? So this could still take a considerable amount of time. And if the Fed hikes, that resets the clock, right? So definitely keep that in mind. Now back to yields. This is the long bond 20-year. Over the past 2 years, it has continued to lose value. So as rates rise, prices of bonds go down. So because rates have risen, prices have fallen considerably, right? And this is where Silicon Valley Bank got into trouble when they needed to meet their withdrawals, had to sell their bonds at a massive loss, and that was the end of the game. Now banks can go to the BTFP, and trade in those bonds at par, and basically the Fed will take those losses, right? They'll hold those to maturity. It won't be a big deal for them in the moment, but at that point we're taking risk out of the equation, right? We're saying like everything is going to be fine, no big deal. Certainly may be the case, but there are many people concerned that rates will continue to rise, right? Again, you have to, as a trader or as an individual living in the world, have an opinion on rates. Just looking at technicals, this thing does not look pretty, does not look happy, and continues to just fall off a cliff, right? And on top of that, if we look at 10-year yields relative to world equity yield on this potato quality chart, for the first time in a few decades, the 10-year yield is above world equity yield. So again, we're going to continue to pull inflows from all over the place, assuming people aren't worried about runaway default in debt, right? That's a big assumption. But in the moment, I don't think too many people are worried about that. And here's the daily return on TLT. First Republic went down, right, in April. Pretty big negative day. And now it's just Friday, Tuesday, Wednesday, whatever, right? It's no big deal that TLT is just hemorrhaging returns, right? So it's definitely an ugly day, ugly set of days for people holding these. And here's another example, right, where US Treasury is trading below $50. I think in this case it was the 30-year, purchased in 2020, expires 2050. So yes, you can hold it to maturity. You'll be fine. You'll get paid par. No big deal. But if you have to sell it for any reason in between now and 2050, it's an issue. And let's go to the extreme that everybody's talking about, the Austrian 100-year bond, okay, continues to just dump value. So yeah, if you hold this thing to maturity, you're fine. But if you don't, you're kind of stuck, right? You can't do much with this in the moment because you take a massive, massive loss. And back to the United States, if we talk about our debt and our need to refi with our own bills, notes, and bonds. Most of our debt has been funded by short-term duration, I believe, because the Treasury didn't want to go far out on the curve to further compete with banks. But now that just means we're going to end up spending more in interest, both in the short term and the long term. And as Max kind of points out, the Treasury net issuance, mainly in the front end of the curve, right? And most of it has come out of the reverse repo. So if we drain this fully, where's the money going to come from? It's going to come from risk, or yields are going to keep going up. And that's going to keep putting pressure on everything. So stay tuned if you're playing the home game, because it could get pretty fun next year if the Fed doesn't cut eventually. Let's move on to the S&P. No change here. I talked about this yesterday. Bearish edge. I talked about the head and shoulders last week or the week before. No surprise that this continues to look weak to me, likely going to 4,200 or slightly less. I don't think anybody's surprised by that, but everybody's sort of melting down, saying, oh, we need to cut. It's been one day. Relax, okay? Mean reversions are okay. This is a great chart from Apollo looking at the top 7 in the S&P versus the other 493. The other 493 have a performance. Now, this isn't total return. It's not with yield, but they have a performance that is under short-term treasuries, under long-term treasuries. So why would you bother, right? Why bother? 5% if you can't see that. The rest of the S&P 7 still up around 50% on the year. And why are they up 50% on the year? Well, if we look at the flows, net trading flows, weekly average, big 7 in the black here has been positive, as in there's been more buying than selling. The rest of the market, there's been a significant amount of selling relative to buying. So no shocker that everything's losing relative to the top 7, and the rich will continue to get richer because they don't need to borrow money. They have it on hand. This is a great graph illustrating that. The smallest 50% of the S&P 1500 firms are paying an effective rate around 6%, whereas the largest 10 are sub 3.5, right? This is exactly like the mortgage graph, where if we look at people who already own a home, they could care less about rates to 8%, 200%. It doesn't matter to them. It doesn't affect them. They'll be fine. The sub 3% rate at around 23%. But it's the new mortgages, which are somewhere close to 8% or higher, depending on where you are, where that's going to be where the most damage is felt. So in a sense, in housing as well, the rich will continue to get richer because you're pricing out basically everyone from buying a mortgage, unless you're buying with cash. Here's just a graph again, just to illustrate consecutive days without a negative 1.5% day. We were on 100 days without a negative 1.5% day. So we broke a pretty decent streak there, but it's not the end of the world just yet. On the Qs, again, same thing. In the cloud, bearish, reversal pattern, bearish, 200-day retest, perfectly reasonable and not worth hysteria at all. Max bearishness would be basically the breakout point somewhere around 315, 320, but this makes sense for a market that's up as much as it is over the course of the year. And if we do around the horn, across the board, the Elite 8, as I call them, I include Netflix in that, none of them look particularly bullish. Google, probably the most bullish on trend, still looks at risk of a further reversal based on a rising wedge. Meta, second behind Google, still above the cloud. But everything else is either in the cloud or below the cloud. That includes Tesla, includes Amazon, certainly includes NVIDIA, Microsoft and Apple being the most bearish of the bunch. So it certainly makes sense to me if the S&P continues to pull back, just based on the weakness we're seeing in the top 7 here. And if we look at microcaps, again, this is just another way of showing you've made no money over the course of the year holding these things. And relative to the S&P, again, the rich keep getting richer. No one wants to touch this stuff. And people would much rather put their money in a yielding instrument that's quote unquote risk-free than worry about dealing with microcaps. And let's just quickly, without anything on the chart, right? You tell me, are you bullish or bearish on the following arc? Okay. I'm gonna go with bearish. Block got extremely bearish very quickly. That's square. PayPal, maybe a falling wedge, but certainly looks bearish. This is going back 5-8 years, losing these levels. Disney, maybe falling wedge, but certainly doesn't look bullish. Etsy looks bearish to me. Snap looks bearish to me. Hood had a chance at breaking out got smacked down back into the range. Coinbase back into the range after breaking out from the inverted head and shoulders. So none of that stuff looks bullish. I think it's very hard to find a bullish chart right now on the legacy side of things. As for GBTC and ETH, haven't talked about those in a while. Both of them still on the bullish side of the trend. Discounts slowly closing, kind of widening and closing a little bit, but definitely closing more than widening here. And both of these still above the 200-day moving average, both above the cloud. Still look okay. I think there are still a lot of people waiting for event-driven volatility to help close this discount further. I certainly am on GBTC. So I think it's got a little bit ways to go. Ultimately, if either of these are below their litmus test for trend, then you're in trouble. But I think the upside for both is still greater than downside. And lastly, just talking about miners. This is the Bitcoin miners ETF. WGMI down around 52% from highs, below its volume node, below the cloud. There's a massive TKC clamp here forming. No bull div quite yet on RSI. I don't think this is a buy personally for me, but it's definitely starting to get interesting as you get this sort of parabolic puke to the downside. And just zooming on one of those CleanSpark, very similar picture, kind of losing all supports in the moment. These tend to have higher beta to spot. So if crypto turns around, if Dixie weakens, if the safe haven asset narrative picks up in a bigger way, I'd expect the miners to start to overperform. But over the past few months, they've certainly come back down to earth. So that's all I have for this one. Like, dislike, comment, share, subscribe. I read all the comments. And happy trading.